Hey guys, for more like this, don't forget to hit the subscribe, the like button, and the notification bell. Okay, everybody, it's Kevin Wadsworth and Patrick Karim, NorthStarBadCharts.com, and it's my great pleasure, my great honor to welcome Peter Grandich to the show today. Hi, Peter, how are you doing?
Well, the feeling's absolutely mutual. I call you two guys that take no prisoners technicians. And the reason I say that, and there's no reason for me to brown nose, it's not going to, whether I'm on again or whatever, but your work is never full of words like if, but, perhaps, on the other hand. So a lot of people do that because then they're covered no matter what happens. They can say, see, I told you, you don't take any prisoners. You stand out there, you share your thoughts. And I think that's very worthy in an industry where uh, there's only two types of advisors, those who say what they think or those who say what they think people want to hear and it sells. You're in the former. There aren't many in that. So I'm as much honored to be speaking to you guys as you claim you are to me.
That's very kind of you to say, Peter. I'm very touched by that. I mean, we have a set of rules and principles that sort of guide us through our technical chart analysis, and I know you have very much the same sort of approach to your thought processes as well. So, I mean, clearly the last few weeks have been very interesting across the markets, particularly stock markets, precious metals, and cryptocurrencies. And we've seen markets, for example, like the Nasdaq and SPX, falling substantially, but then regaining some of that ground. And the sentiment in some quarters, at least, seems to have shifted much more bullish, particularly stock markets and cryptocurrencies. I think Bitcoin's recovered about 60% from its lows, but it remains more than 60%, of course, off its all-time highs. So probably a certain amount of confusion out there at the moment. And I know what our feelings are. Our technical analysis is very clear and makes life somewhat simpler for us. But perhaps you can sort of explain how you're viewing the markets at the moment, what you're thinking perhaps across the commodities sector and for the stock markets.
Well, net, I'm quite bearish, but I'm bearish in a much longer term frame. I think a lot of your work is very, very useful for people near term to intermediate term. Uh, my concerns are with some very serious fundamental problems in the US. It may be similar in other countries, but I focus just on the US. The debt crisis everybody knows about. I mean, I never thought, I'm coming up on my 39th year in around this financial arena. I never thought we would have $1 trillion anything debt. Now we have $1 trillion deficits, let alone 32, 33 trillion. But the CBO came out with an interesting study and said, based on how government spending is going, it's going to add another 19 trillion to that number. And when you start to think of that number and you put just a 3 or 4 or even 5% interest rate on it, the interest expense is going to become a serious issue. Forget about ever paying back that amount, the interest expense. But the one that I'm more concerned about, which isn't prevalent, and it's certainly not going to be because Wall Street lives off of this, and that's the coming retirement crisis. About 75% now, all sorts of studies done by different sorts of people say about 75% of Americans are working paycheck to paycheck. And so there's a real hard difficulty there to save. In fact, because of the inflation pickup, we've seen a dramatic increase in them using credit cards in order for necessities, to pay for gas, to pay for food, etc. So there's a retirement crisis. And within that retirement crisis, there's a coming what I call a both political and aging crisis. Now, Patrick will be somebody he might have heard about it and all because in Canada now, because of the socialist medicine, they are actually talking about encouraging people that are quite older to consider, ending their life versus going through. And it's real. It's happening. And here in the U.S., we have about 8 or 10 states now that allow assisted suicide and all of that.
Right.
And why I bring that up because it doesn't make people happy, but think about it. You're a young kid 10 years from now, they've taxed you to death because that's governments can only cut spending and raise taxes. They're no good at cutting spending, so we know that there's going to be a lot higher taxes. So some young kid's going to go, wait a minute, some 80-year-old person on Medicare is going to get a $500,000 operation for whatever it may be. No, no way. Yet that 80-year-old person is going to say, I paid in all these years, I'm deserving of this. So this isn't going to impact the stock market tomorrow and the next week and next year. That's where you guys really specialize in. But anybody that's doing planning or thinking about what it may be like 5 or 10 years from now, and that's still a lot of people, these are things that are happening. And at a time, and I'll end on this, at a time when our political process in the US is totally dysfunctional. This will be the most dysfunctional Congress in modern era because not only will Republicans and Democrats refuse to work with each other, they each have a fraction in their own party that differ from their views. So at a time when real hard fiscal decisions and hard decisions, we're seeing it now, they're talking finally about, the entitlement issue. We're not in a position to do anything about it. So I can just tell you this does zero for my planning business. In fact, it chases away potentially somebody that might have otherwise if I was a little bit more cheerful. But it's the reality I see. And for whatever's left of my natural life, I think I'm really called to speak reality, not what, make somebody a client or something.
Yeah, it's I'm wondering what the it's like how are the masses gonna navigate all of this? Because I know when I go to well, anybody who goes to their bank, it's all cookie cutter. You have a financial advisor, right? The bank is, well, buy the SPX, buy the SPX. It always goes up. Like before we're talking, we record it always. And but if somebody wants to retire right now, right, and this thing implodes right now, and nobody told them to sell, nobody told them you could hedge buying commodities or whatever. Sometimes I feel it's super tough for there's gonna be a lot of pain for a lot of people out there, and I don't know if, like how do you think about that there? All this.
Well, the natural tendency, Patrick, Kevin, is going to be go to the government to seek help. I mean, that's here in New Jersey, the state I live in. One of the acute problems is senior housing for seniors because they can't afford high price and low to middle income, uh, which is quite difficult. So when those people have difficulty, they're going to seek the government to help. And we're now having millions, and I mean millions of people coming into the country, both from now, not only from the south border, but from the north border as well. And they tend to not get up too high of the food chain, and they fall into more of the area which seeks government assistance for various different things, food stamps, et cetera, et cetera. And it becomes a hard personal, philosophical, spiritual crisis as well, because, uh, you know, for a lot of years, government wasn't the main supporter of the poor. It was people in church and spiritual movements. But even there now, here in the US, it doesn't matter where you go, food back lines are longer, and they have people working at higher levels of income needing to come there to supplement their food. And again, this is not a discussion. It's never going to be discussed by what I called, as we spoke before, the don't worry, be happy crowd that makes up most of the financial service industry. But it is things to be concerned about. But I don't want to take away, because as much as you want to have me on, I want to be on with you so my people can learn about you, because you guys, Patrick, when I read your stuff, I look at you and you're going, there's no taking prisoners when you post something. There's no, yeah. Listen, take this. If you don't like it, take a long walk on a short pier. Is basically, and that is so critical from investment advice, whether it's technical or fundamental, that you clearly understand that we're not, there used to be a lot of people that did the Elliott wave theory, and they would go out and say, well, this is an ABC that's what we think is going to be. It doesn't go that way. Or when they come back out again, well, it turns out it wasn't an ABC. It was this, that, and the other. Instead of saying, hey, I was wrong. I thought it was an ABC, but it wasn't. In your work, from everything I've seen, there is none of that. And I have to credit you guys that. That's why I was, so happy to speak with you, because That's what people really want at the end of the day. Yeah, there's always going to be a few trolls that are out there. Oh, you said this and you were wrong, like you're going to be right 100% of the time. But most people are glad if you're upfront and honest. If you're wrong, that's secondary to them. Versus they said, wait a minute, he's making like I lost because of what he said. What is he or she saying? And so I commend you guys for that tremendously.
It's Kevin says it often there. It's all about probabilities. So, and the charts, yeah, Elliott wave, maybe like, I understand it exists. I personally I don't like it too much because I feel there's missing elements, but essentially with 3 trend lines, we could discern the probabilities depending on the time frame, right? If we zoom out, we could we could assert the probabilities of those huge moves, right? And it's been a while back there that the SPX broke down versus the producer price index, and that's happened only like 4 times in over 100 years. So my conviction level, the way I assess probabilities, that huge piece of element, because I'm looking at a 100-year chart, and it's only the 4th time ever we've had that single. That's why I could have such a high conviction level that there's a paradigm shift that's happening, right? That whatever the destruction of U.S. purchasing power is gonna go down the drain. Inflation is going to go up. Commodities are going to go up. So because I'm looking at a higher time frame, I don't flip flop as much as somebody who's looking on the daily chart. It's like I could have a bear market rally for months, even a year, and it won't break my overall thesis that we're still in a long-term secular uptrend commodities and downtrend in growth stocks. But the day if ever something happens,
yeah. Sorry, go on, Patrick. Yeah.
If ever something happens and the SPX starts breaking out versus commodities once again, or versus the producer price index, of course we're going to say, well, okay, my thesis now it's broken. Now it's something different has changed that we weren't aware of. But the more you collect evidence, the less you're going to be flip-flopping all over the place. You know, it's like any professional hockey team, right? The coach is going to do research on every single player on the other team. He's going to understand their weaknesses. You have to understand the whole game to make sure that you have a good game plan going forward. That's it. That's my rant, Kevin. Your turn.
I was just going to say that what's important here is having points of reference. And when you're trying to forecast the future, the big mistake, Peter, that a lot of people make when they're trying to predict the future of a horse race or in my previous career, trying to forecast the weather a week ahead, people very often get the idea that it's about a black and white answer. It will do this or it will do that. If you're going to be honest about it, there's a whole range of possible future outcomes. When you're looking at something that's going to happen a year from now or 5 years from now, there's a number of things that could happen between now and then that shift the likelihood of where we're going to end up. So forecasting is about 2 things. It's about getting a point of reference and getting your thesis, your overall weight of evidence, and coming up with your roadmap, if you want to call it that. And the other part of it is tracking your route as that roadmap develops. It's like using a map, and you're going on a hike. You take your map with you. You know where you're supposed to end up, but as you walk along your route along your hike, you have to refer to the map to make sure you're on the right path, because you could be about to wander off a cliff somewhere. So it's very, very important that A, you have your roadmap, and B, you track what's happening as you go through time, because as you go through time, all of those probabilities, all of those things that might possibly happen, like the branches on a tree diverging from your starting point, they all start to come into effect. And that's something we call chaos in science. It's called chaos theory. And stuff can happen that completely radically alters future events. But no, I mean, having that kind of that roadmap really does make a huge difference. So, and what are your general sort of views and opinions then on? I mean, you touched earlier on the problem that we have with US debt rising at an incredible rate, and the fact that they just paying the interest on that debt becomes a real issue. And me and Pat have spoken about this in the past, and there's a couple of ways out of that. One is to rapidly increase GDP, and that really helps with the problem. And the other is to have high levels of inflation, because that inflates away the debt. So in a sense, there is a kind of way of mitigating that nominal rise, 30 trillion, 32 trillion, 33 trillion. If your GDP rises to match it, then your ability to meet the debt repayments is maintained to an extent. And also the same thing happens if you have very high inflation, because that 33 trillion might end up, being the price of an average house. So I'm slightly exaggerating, but you get my point. So, I mean, how do you see that really becoming a major insurmountable problem?
So, Kevin, I wouldn't, for myself, count on GDP being the answer. Okay, I think there's too many issues now. We didn't even get into the entitlements, which both between Social Security, Medicare, and Medicaid, some estimate is another 70 trillion that's going to have to be paid out. And there's no money sitting somewhere for this stuff to come. Okay, so you throw that onto the 33 trillion, and then there's 100 trillion there. And then there's all sorts of, because you guys, we were all talking before we came on, you were looking at public debt and all this stuff. We don't even talk about, at least the United States government has the Fed, which can print money. On the state and local level where there's debt issues, they don't have that luxury. They have to actually do something. And that's one of the untold stories yet in the public pension system in numerous states now are greatly underfunded. And the performance of the stock market only made that worse because they primarily used the stock market. And one of the other things that the Fed did that only now I myself am living through because I'm a senior now, and that is they destroyed the fixed income market by driving interest rates down to zero. They literally made it where the only way you can get a return on your investment is you had to take risk of principal. Nobody could live when it was 1 or 2% CD rates. How much do you have to have in dollars to earn 1 or 2% to get by buying a livelihood and all? So I would say that the GDP rise won't happen. Higher inflation, yeah. One thing I can tell you, a politician would rather deal with higher inflation than strong deflation. Deflation causes a lot of more issues for them. And listen, this is a country that has kicked the can on all sorts of levels. The can got heavier and heavier. And there comes a point where you go kick the can, and you go, ouch, and your foot hurts, but it doesn't move. And we're getting close there. They'll do another debt limit, last minute thing, but it's becoming more and more difficult to keep pushing this aside. And we haven't talked about what amazes me has gone off the radar for people during this, and that's the potential derivative problem and how much in derivatives worldwide exist. And I always tell everybody, it's like that domino thing when you see on TV where they've set up 3,000 or 5,000 dominoes, and all you got to do is hit the first one, and then they all fall. That's where the derivative market could become a serious problem. But again, no one likes gloom and doom unless I was selling ammo, cars, cabins in the woods, food supply, on your own. These are type of subjects that the average person doesn't want to hear, but I think it's all going to be part of our future, unfortunately.
Unfortunately, the average person gets exposed to a lot of misinformation as well. I was just watching the BBC News here in the UK over the last few days, and our inflation rate over here is somewhere around about 10% at the moment, and it has been for around about a year. So we've got a lot of strikes going on. The nurses, the doctors, the public transportation workers, teachers, all going out on strike because they want pay rises. Unsurprisingly, a lot of them actually haven't had pay rises for a couple of years. So with inflation, 6, 7, 8%, a year ago, rising through 10%, that's how much prices have risen over the last couple of years, perhaps 15 or 20%. So they're expecting, or they're asking for pay rises of at least 10%. And do you know what the BBC said? When I was watching the BBC a few days ago and again today, they said, well, of course, it's worth bearing in mind that inflation is now cooling off to 8%, 6% is expected to be 4% by the end of the year. So that needs to be factored into any future pay rises, and the idea of getting pay rises of over 10% is unrealistic. Well, hang on a minute. If you get a pay rise of 4 or 5% to match the current rate of inflation, what's happened to the inflation that happened last year? That's already baked into the stuff that you're buying. So the price has risen. It's not coming back down again. It's just going up. Even if inflation is 2%, that means your prices are still rising. So all of that inflation for the last year is locked in there. So yeah, they've got every right to ask for 10 or 15% pay rises because that's how much the prices have already gone up. And yet the mainstream media sort of seem to want to get this idea in our head that oh, they only need a 4% pay rise because inflation is going to come down to 4%.
It's what Peter mentioned. Even the higher worth people, they're starting to make the line to have help. Because I remember this morning, my girlfriend sent me a clip from the newspaper. This guy saying to be in the top 10% of Quebec earners, you have to earn that much. I said, Jesus, like, even with that amount, I know that life's hard, even if you're the top 10. So imagine now the top earners in Quebec, it's hard. You can't buy a house. The cost of everything is going up. So it's inflation. Even I know the high net worth guys, they're not impacted yet, but it's starting to hit the middle class. You know, it's dragging everybody down there.
Well,
Here, I'm sorry, guys. Here in the U.S., and it's probably in a similar way in both respective countries, the middle class or the people that made up the bulk of people. You know, you had unfortunately, the poor and you had the very wealthy, but the middle class used to be the biggest part of a pie if you looked at it. That here in the U.S. has come like this. Now, some made it up, but unfortunately, more went this way. And that hasn't been taken into account when people still start talking about future and earnings and all that other stuff and all. And there is just, at least on Wall Street, I can't talk about Bay Street, I can't talk about London, but there is this don't worry, be happy attitude that exists in the financial service industry. And you know, my sarcastic joke, which has seriousness behind it, is you can toss most of these advisors off the top of a building all the way down. They'll say the same thing. Hey, so far, so good, until you have this. And that's what's going to happen until we have this. And it's just so prevalent. The action taken by government will keep pushing it off. But I will tell you this much. I was surprised here in the US. I thought it would take longer, but it's because it's come so acute. We used to say for a politician to talk about cutting Social Security was like putting his or her foot on the third rail. They might as well commit suicide because if you brought it up, no one would want to speak to you or have you as their politician. Both sides spoke about it, but when they saw the reaction from the public, they pointed, no, they said it. We didn't say it. They said it. But it's out in the open now. And there's only two ways government can do anything. They can cut spending. I presume in Canada and the United Kingdom, that's pretty difficult for politicians to do like it is here in the US. Or what they like to do is raise taxes. And they raise taxes in a lot of different ways now. People don't realize how taxed they are by fees and other things that the government collects versus a straight income tax or something and all. And it's getting to the point where more and more people getting in the wagon, and those of us less working are pulling harder and harder and say, wait a minute, I like to get in the wagon too. And unfortunately, there's not a lot of money speaking about this. I can tell you guys that people don't line up and go, man, I just heard this guy Grandich. I got to go with him because the end of the world is coming. I should go out with him. But the bottom line is, I think there's a lot of serious stuff. And I don't want this conversation because even Patrick put up something today that was really good, showing how uranium is breaking out. There are areas and all that I think people can still go into, and you guys can talk about it as well. Patrick brought up how the price of uranium, how it's looking. There's no question that nuclear energy must, if we're going to have all this electrification, here in the US, our grid is so old. I like to joke that Thomas Edison built some of it, but they're thinking ahead. They're getting all these things that need electricity, but they're not quite keeping up with how you get that electricity from the minerals that are needed all the way to providing the electricity, you know, through various ways, stations and things of that nature. And I think that's where there's still be opportunity. The commodities that are involved with that and the structure type of stuff that surrounds that is where money could be made.
Right.
Yeah,
it's all cycles. Yeah.
I was just going to say that's fairly clear in the ratio charts as well when you compare certain commodities to what's happening with the stock markets, for example. So you can see those capital flows leaving sectors of investment sectors and moving into other sectors. And of course, it doesn't take very much to move into sectors like precious metals or base metals or uranium for a very large effect to take place. Sorry, Patrick, you're saying.
Or oil, or like all these things are. I don't know if I got it from you, Peter, but anything that you hold in your hand and you drop and hurts your foot, that stuff, that real stuff, as they're destroying your purchasing power, that's creating a floor for the price of all these commodities. And then after that, you have cycles, because these commodities were so undervalued versus growth stocks for 10, 20 years, or since 1980. Then it's just a pendulum swing. So it's getting two tailwinds: the destruction of U.S. purchasing power, and plus just a cycle of under. I can't find my words, man. Kevin, help me. We're under, like.
So one of the things that it's important as you talk about that is, in the area of looking for metals, it has to start. Somebody's got to first go find them, develop it, get it out, so then it could be used for all these other things. I like to say that 20 or 30 years ago, we could be in a room, spin a globe, point our finger down and go, yeah, it's okay to go there. Not anymore for mining companies. There's a lot of issues in different areas of the world, from political, economical, social, where it's quite difficult. And there's been an underinvestment, same thing in oil,
Yes.
of looking for this stuff. And so while everybody's going the electrification way full blast, got their foot down, all our governments here are getting electrical cars for state cars, everything. No one's talking about that. And then the real area that causes an issue is rare metal minerals, where there's these, I can't even pronounce the names, Patrick and Kevin, they have these weird names. They all end like an ISM or something like that. But China basically has control of them. So we're running out and doing all this stuff. And where are we going to get it from? And you can't do this in a day, week, or a year. You can't find a copper project, develop it, get it permitted, and start delivering that copper for all the extra needs now that is needed for copper, for electrification in a car, cobalt, whatever it is. So I think in that area can perform above average, even if the stock market is not a place that's going to go higher anytime soon. And if I could just say one thing about that, the financial planners in the US use what's called this 4% rule. We might have spoke about it before. The hope is that the stock market averages 8 or 9. You take out 4% to live, you're retired of, because you figure out how much of that is what you need to live your life. Market goes back up again, you take your 4. Well, last year was a pretty tough year for that type of financial planning. And even if the market doesn't go up, but if it just stays where it is, that's another year where they have to draw principal where it hasn't been replenished. And what's real interesting now, and again, not talked a lot about, is over half the money in the US stock market now is in passive investments, meaning they're being managed not on an individual basis, sell this stock, buy this one, but against some sort of performance, an index or what have you. And it was great when the market was going up because it came a self-fulfilling prophecy. Those funds had to keep buying. Last year, it changed on them. If we get another year like that, if some of the people that are looking for a crash, I'm not one of them, but if there was a dramatic decline in the market, there are a lot of people that are going to see forced liquidation. And that will clearly be signaled ahead of time. And you're the type of guys that'll see that, because that movement starts before everybody gets caught up in it. And that might be a thing that you guys would like to speak about. I would like to hear, because I think that's an important thing for the next several months. Where the stock market goes or doesn't go for the rest of the year is going to dictate a lot of other things for a lot of people.
I think a lot of people do forget, even, as recently as 2000 to 2015, that period of time, NASDAQ peaking in 2000, it took 15 years to get back to those levels. And I guess a progressively greater amount of investment finance has gone into tech-heavy indices, tech-heavy ETFs. And so, historically speaking, you don't have to go back very far to find a period in history, a period in time where NASDAQ and also SPX took a decade or more to recover the previous highs. And that's without taking inflation into account. If you inflation adjust SPX and NASDAQ and start trying to figure out how long it took them to get back to highs, inflation adjusted, then it's even longer. and it could quite conceivably be 15 to 20 years to recover inflation-adjusted highs. So that is, and each time this happens, of course, it's making a real hit on the average person in the street, if you want to put it that way. So people who are retiring or coming up to retirement, particularly around about now, if you're looking forwards at 10, 15, or maybe even 20 years of inflation-adjusted losses, then that's a really big hit to yourself personally, and also a massive hit to the economy as well, because of course people have less purchasing power, so that has a big knock-on effect on the state of the economy. So it's like a boxer getting hit multiple times until it falls over. So that is kind of the situation that we find ourselves in across quite large sectors of the economy, I feel, at the moment. Things like, as you already mentioned, national debt. Just how bad does it have to get before something really seriously breaks? You mentioned the derivatives market. Each time these parameters get pushed to their limits, you're at risk of something very serious in the system breaking. And the bigger the debt, then the more horrendous those implications might potentially be.
Before we run out of time, I would like your guys' opinion, and I'll speak a little, give you time to get your charts, because I know what the work you've done, but I would like certainly everybody that I know to recommend to see is I want to talk about gold for a moment, and then you guys can share from a technical standpoint where he was. There's been a dramatic change from the gold market compared fundamentally from when I was involved 20 or 30 years ago. First of all, back then, almost all the paper trading of it was between London and the US, New York. The COMEX, I've always called it the CRIMEX, but a dramatic shift has taken place to where a lot of the paper trading now has moved to the Far East. And with that, it seems to me at least, a lot of the manipulative stuff that used to happen, sudden great falls that would happen, at 5:59 at night, somebody decided to sell $1 billion worth of gold, which would make no sense. That has been an important aid to the gold market. But the central bank buying, the amounts that they have purchased, whether it's one or more than one, is just off the charts. And my feeling is central bankers are not doing that to speculate or trade. There's a reason or reason, something monetarily, something there. Either they eventually see a move away from the dollar, or a new currency being introduced, whatever the case may be. And of course, I was all excited. We were approaching 2000, and I'm like, watching my thing. And then somebody said, maybe worst case 1850, even though I was reading a certain guy named Kevin writing that we can still, it might have been Patrick too, we could be back down to 1800. And I kept saying, I hope my boys are wrong on that, because I don't want to live through that. But guess what? As we speak today, we've had a serious pullback. So before we ran out of time, for my edification, to able to grab you guys for an in-depth view, maybe you can just share with me and whoever watches this what you think of the gold market right now.
Yeah, sure. Well, I've got the gold roadmap on the screen now for people to look at, and I'll be honest with you, Peter, this hasn't really changed over many years. Myself and Patrick have been drawing these roadmaps for gold ever since we started to see these big drops back in 2012, 13, 14. It became clear that we were building this base out, and as this base developed, it became very clear when we had the breakout what the target was likely to be. And anyone that follows me will have seen on Twitter back in 2019 the projection which I made from when we were down here at around about $1,300, that we would be moving up to $2,000 and then building a consolidation pattern. So back in 2019, that forecast was issued. We hit the 2000 level. We had the consolidation. So the question is, what happens now? So this is the updated gold quarterly roadmap with the long-term bull market support line shown on there. And also we've got the 12 and 36-month moving average. So we've had a number of attempts actually to break through this level, which is close to the $2,000 level. It's actually a little bit below it at around about 1935, 1940, that kind of level, 1937. And there are many months, in fact, all the way up until 2025, technically speaking, where this chart is technically allowed to track sideways before breaking to the upside. But that doesn't mean I think it's going to take that long. My and I think Patrick's assessment as well, is that the probability of a downside breakdown is low, and the probability of an upside break is high. It's very important that we monitor the level that's involved in indicating which way it's going to go. That's around about 1660. That's where the support line is, and we've got the 12-month moving average at around about 1807, I think it is at the moment. So I think my general feeling at the moment is that this 12-month moving average is quite likely to break to the downside, and it's quite likely that we do test lower levels.
Sorry, Kev, that's a 3-year moving average. You're on the quarterly chart.
I'm on the quarterly chart. Thanks for pointing that out. So I'll just get rid of that moving average there. So the 12 is the 3-year moving average. So the 3-year moving average, that makes a lot more sense, because I was just thinking in my head that the 12-month moving average is also at around about the same level, around about 1805. So both the 12-month and this is the 3-year moving average, the 12-quarter 3-year moving average, both at around about 1805. So there's a fair amount of support in there, but I've got a feeling that we're quite likely to see some kind of market event, because I'm looking at charts for the SPX, the NASDAQ, Amazon, Netflix, Meta, Google, looking at what's happened recently with cryptocurrencies. And a lot of these charts are in technical chart patterns, which suggest a reasonable probability of or reasonable likelihood of a pretty sharp move to the downside. And if that were to happen, I think the most likely outlook would be for stock markets to fall quickly, but gold and silver to fall, but not quite as far in percentage terms. So I think gold and silver will drop. They'll be pulled down, but in percentage terms, they're likely to start to show relative strength versus the stock markets, and I think that will show in the ratio charts. So
yes.
what we're looking
pop that up, Kevin.
Yeah, can do that. Yeah,
Peter, this is key right now. The gold to SPX ratio has always broken out technically in favor of gold to create tailwinds for silver, for the miners, for oils, like all the commodities. Gold is the counterbalance of all the destruction of purchasing power. So if there's so much destruction of purchasing power that SPX growth stocks, the price to earnings don't make sense anymore, gold has to outperform SPX. If gold's not outperforming SPX, people are going to say, well, I'll just keep playing the index, right? So this chart right here, the gold chart is probably going to break out at the same time that gold breaks out versus SPX. And this is key. This is how this is how we're defining capital flows. So either growth versus commodities or gold, fighting it out through the ages. And these signals, we've had them. This would probably be the 4th time in over 100 years we get a signal, let's say, in favor of gold, if ever SPX or if ever gold's able to break out versus SPX. And Kevin's going to show now the technical levels required for that to happen.
So this is a chart which shows very clearly when to buy gold and when to sell gold in relation to the stock market. If you are going to hedge your investments so that when the stock market turns down, you purchase gold, and then you move back into the stock market when the stock market begins to outperform gold. And you'll notice that these buy gold indicators, 1930, 1968, 69, 70, that whole period there, and again in 2002, are right at the start of huge gold bull markets where gold moved up by many hundreds of %. And so this straight black line is the ratio breakout line. We often refer to it, myself and Patrick, as the wake-up line. You kind of see the ratio chart moving through the wake-up line, and it then has to get above key horizontal resistance, and that's the indication that the bull market is on its way and developing strongly. You can see here, breakout through the wake-up line, that's the black declining line, and then it halted at key overhead resistance, then broke out, hit the next key horizontal resistance, broke out, and each one of those horizontal resistance levels, as you break through it, is reaffirming and reconfirming the precious metals bull market. So what's happened recently? We have been pulling back, interestingly and significantly in the form of a bullish descending wedge. Bullish because the resolution when it comes will be to the upside, and that'll signal the next precious metals bull market. So whilst we're monitoring the gold chart and monitoring the chart that I just showed you for signs of a breakout, there is no confirmed breakout at all until this chart not only gets above this wake up line here, this declining black resistance line, this one here. It's got to get above that, but it also has to get above this red line here. The red line represents gold being worth 50% of the SPX. So if SPX is 4,000, gold would need to be 2,000. If SPX is 3,000, gold would need to be 1,500. So if SPX does fall to 3,000 or somewhere just above 3,000, which isn't at all impossible, this chart would start to break out with gold above $1,500, $1,600. And that's quite a likely scenario. I think both weakness in the stock market and gold will initially lead to a breakout here. And then it'll continue to move to the upside as gold moves strongly into its bull market, but that has not happened yet. It's why myself and Patrick have not been all over Twitter and all over social media saying buy gold, buy precious metals. Now's the time to get, to get involved, because it isn't. There is no confirmation, and that's this particular chart, above all others, has helped us and those that follow us to avoid jumping into a market that just isn't ready yet. The time will come, and of course the mining stocks will be highly likely to outperform the metal itself during certain stages of that bull market, although of course over time, believe it or not, the actual metal is a better investment than the miners over longer periods of time. So that's where we are with gold. It's where we are with gold versus the SPX, and spotting these flows of capital from a huge sector like the stock market, or from the M2 money supply. You can do it gold versus inflation. You can do gold versus a number of other key sectors. And spotting these capital flows, it's like a two-horse race, and it's telling you which horse is winning. And ever since this point here in 2011, because the chart's been going down, SPX has been winning, just the same as it did all the way from this point here in 1980 all the way to 2002. The stock market was the winner, and then we had a short period, 2002 to 2011, where gold was the winner.
I just want to highlight to Peter, though, just when gold broke out in June of 2019, or in 2018, late Q4 2018, started to bottom, and it moved from 1,100 all the way to 2,000. That was that crazy gold move. That was actually just a bear market rally versus the US equities. And nominally, so the way you got to see it, whenever gold price goes up, that means nominally the Fed, the governments are doing something to destroy your purchasing power to keep afloat nominally the SPX. And that's the cost of keeping afloat the US equities, is a higher gold price. So the way I see it, Peter, there is a way out of these trillions of debt. It doesn't matter. All they have to do is have a higher gold price. Because if you take the total, they could add zeros. It's like the Zimbabwe, Peter. The debt could be trillions, could be gazillions. It doesn't matter. You have to divide the total debt by the price of gold. As long as you keep adding zeros to the price of gold, that will reflect the truth in the illusion of what fiat currency is. It's nothing. It's like, it's worthless. It's the relationship of your fiat. How much fiat do you need to buy an ounce of something real like gold? So always divide. So the total public debt divided by the price of gold, and you'll see how much leeway they have to keep adding zeros. Because like you said, they're going to add zeros to the debt. They're going to use destruction of purchasing power. They're going to create inflation. But gold has to reflect that. If gold does not reflect all these adding of zeros, then yes, something will break.
And this is the M2 money supply to gold ratio. And you can see it doesn't take very much for gold to rise quite significantly when it begins to outperform the money supply. When this chart moves to the downside, it means that gold is outperforming money supply. When the chart moves to the upside, USM2 is outperforming or rising more quickly than gold. And just a little downtick like that caused gold to rise $200. A more significant pullback there allowed gold to rise $800. This pullback here from 2001 to 2011, of course, allowed gold to rise over 700%. So this chart pattern, being in a bearish rising technical pattern, does look strongly suggestive of a developing gold bull market in the near future. This small bearish rising wedge has actually broken to the downside and is currently in the process of back testing that breakdown. So charts like this, when you put them all together, these ratio charts, they start to build a picture like putting a jigsaw puzzle together. And you put all these pieces together and you start to see the overall picture. And that's what we call the weight of evidence. It's not just considering one chart. It's not just putting a couple of lines on a single chart. It has to be in the correct context. You need to know if you've got the wind at your backs. It's all very well having a little pop in a stock, a gold stock or a gold miner, but if the overall sector isn't outperforming SPX or M2 money supply, then the likely result is that it's going to turn down and end up tanking and moving to much lower values. Whereas if you've got the capital flows and the ratio charts working for you, it gives you that push and it gives you much more confidence that the stocks that you're following in precious metals or the uranium sector or the oil sector, whatever it happens to be, if you've got that push of capital behind you, then you can have much more confidence and much greater confidence levels that every pattern that develops is going to resolve to the upside. And it helps to explain why sometimes, and this is quite important as well, people will look at a chart and they'll say, oh, there's a bearish rising wedge there, so that means that we're going to move down. And it ends up actually moving to the upside. And there are quite a number of examples when you look at the gold chart in the early 2000s where we had bearish rising wedges, which tradition the expectation would be that a bearish rising pattern would resolve to the downside, but they didn't. And the answer as to why they didn't is because the capital flows had shifted. We were seeing breakouts of gold versus SPX. We were seeing breakouts of gold versus money supply and gold versus inflation. And when you've got those macro winds behind you, it means that when you do develop bearish patterns, they're much more likely to surprise everybody and break to the upside rather than the downside. It accounts for the sort of 10 to 20% of occasions when bearish chart patterns don't go down, they go up. So it's kind of allowing us to x-ray the patient. These ratio charts allow us to x-ray the patient and give a diagnosis based on an x-ray, an MRI scan, blood tests, DNA tests, all this kind of stuff, rather than just trying to diagnose a complicated disease by visually looking at the patient and saying, well, it looks like you've got a bit of a virus. What kind of virus have you got? What are the details? It kind of helps to know, because if you don't know, you don't know what medicine to give. And it's the same with the charts.
So you guys, there's one thing now, because I did this interview with you, because I'm long gold. I was going to have a steak. Now I'm just going to have a ham sandwich.
Well, go on, Pat.
Well, yeah, it's close. It's close. It's like it's just we're super close to, like Kevin showed, the breakout lines there. The true multi-year move is with a quarterly close, a convincing quarterly close above 1950 for gold. If ever you get a quarterly close above 19, a convincing one, it has to be convincing. Can't be it's like you have to always look back at June or Q2 of 2019. If it's convincing, man, that move is going to be epic. What's going to happen right now? So now the market forces are working it out. So we just got to take a step back, wait a few months, wait 6 months, let the market give us that clear signal, and then we're just at the beginning of a multi-year move. But you have good clues, Peter. That uranium chart versus SPX, it looks great technically. Usually oil and uranium, for some reason, they are some of the early runners in these commodity bull runs. It's like oil and uranium from 2000 to 2008, they just went bonkers. It's like, so the clues are there, but the confirmed breakouts, they're like, we're just waiting for them there. But for me, the probabilities are higher that we get a confirmed breakout than a confirmed breakdown.
You mentioned uranium versus SPX there, Pat. So I feel like I ought to just quickly show people that chart. That's this is URA versus SPX. It's the uranium ETF, and pretty clear what's going on here. We're broken out. We're above the 3-year moving average. We're in a pennant formation, and the only hurdle that now remains is the final breakout line here. And you can see the bullish move that we've moved. I mean, we've got a nice arc basing pattern here, and if you're not sort of a fan of these arcs, all they are really is just describing a natural basing pattern that takes place across many different sectors with stocks and shares. It's not unusual. Stan Weinstein described it in his stage analysis. So stage 1 basing pattern is what's going on at the moment. And a guy called Wyckoff also described it with his accumulation and distribution patterns, accumulation at the bottom and distribution at the top. So these arc patterns are just a simple visual way of representing something that has been described by many analysts in the past. But a clear breakout here for URA versus SPX. And it takes time, of course it takes time, but when we get this next breakout here, this is the first major consolidation in the bull market. And when we get the next breakout, we can expect some fireworks for URA, uranium miners, in relation to their outperformance of the SPX.
All right, so let's end it on a good note with the uranium.
Always good to end on a good note. And there's always there's always some corner of the markets where you can make your investments work for you. And this is something that, if you're really stuck in gold or you're stuck on uranium or one particular sector, you need to just broaden your view a little bit, because whilst one sector is in the doldrums, then there's always other sectors that are benefiting from those capital flows.
Well, I just hope people realize how serious you guys take your work, and it was a pleasure to speak with you again, and the honor was all mine. And I'll know certainly from you guys ahead of time versus some other people. And I think that's all you could ask for. And you made one other point early on, Kevin, and it's really important. You're talking about probabilities. That's all you could ask for is probabilities. No one knows for certain of what anything's going to do. But when probabilities highly favor you and you keep acting only when they highly favor you, you'll make money. And the fundamental response to that is it's not how much money you make, but how much you don't lose is going to separate you from the winners and losers. So that's the fundamental to what you said from the technical. So thank you for having me. You took my mind off a lot of other things that have not been great for me lately, and I really enjoyed this conversation. And I hope you guys, you share a lot for free. I can tell you that. And it's nice that you do that. But I hope people realize, because the internet has spoiled some people now. They think everything should be for free. Why should I pay for anything? But realistically, what you guys do, and anybody serious about their investing, I think they should take a good hard look at what you guys do. And thank you for having me on again.
It's very nice of you to say that, Peter. We do appreciate that.
Yeah, it's our honor to have you on, Peter. Seriously, it's so. Anytime you want to come on there, just beep us up, and we could have a beautiful 30-minute chat there.
Thank you very much. God bless you guys.
Thank you, sir.
Cheers, Peter. Bye-bye for now.